sort of example of how this all plays out in practice. So this comes from a paper that I published with my friends at Georgetown, and it's called Risk-Based Dynamic Asset Allocation. I mentioned earlier that one of the solutions that we believe is important is to be more dynamic with your asset allocation. I mean, if returns and volatility are not dynamic, not static, why is portfolio static? In many cases, our portfolios are very static, but that doesn't reflect the reality of markets. Clearly markets are not static. So one of the things that I would like to see us do more of as an industry is to be more dynamic with our asset allocation. And this is one way to do that. We have a number of articles that we published along these lines. Obviously, I can't talk about all of those today, but I'm going to just give you one example here that we use in this particular paper. So the point of this paper seems very straightforward. We're going to dynamically adjust our portfolio based on our risk, our market forecast for risk. That's it. We're only going to forecast risk and make modifications to our portfolio with new risk forecasts. So in other words, we're not changing the expected returns at all. Okay, so it's pure risk-driven forecast, pure risk-driven asset allocation. So we're going to use a fat tail model, as I said before. We're going to estimate market risk, and then we're going to forecast risk 20 days in advance, so 1 month in advance, and then we're going to reoptimize the portfolio given that risk forecast. Okay, it all sounds pretty straightforward. We're going to use C-bar. I don't know if you guys use C-bar or not. Another word for C-bar is expected shortfall, right? So expected shortfall is the notion of how much would your portfolio lose in a 5% tail event. Okay, so a 7% C-bar, this is an example here, a 7% C-bar means that your portfolio, you would expect your portfolio to lose 7% in the worst 5% cases. Okay, so that's the sort of thing, that's the construct that we're going to use here. Everyone okay with that? Okay. I won't go into the other components of C-bar. Okay. And as I said, we're going to keep expected returns constant, and we're going to have a policy allocation across not 2 asset classes, but 5. We're going to use fat tails. We're going to use a generalized Pareto distribution. I mentioned before about how we're pulling them from the literature on hazard insurance or risk insurance. This is an example of that. And so just by way of showing that the normal distribution doesn't work very well, this curve, this is the left tail, and this dashed line is the normal distribution. The dark line is the empirical, so those are the actual observations. And then the solid red line is our model. So the point is that our model is much better capturing the historical observations than a normal distribution. And this is our C-bar. The blue line is our C-bar, and then the green line is the S&P 500. So what we're going to do is in this particular paper, we're going to assume that markets have 2 types of, markets live in 2 worlds. They live in a normal kind of world and they live in a high risk world. I mentioned earlier, you can sort of see that. You can see it here as well. So I drew these 2 bands. So if you're within these, essentially if you think about it this way, it doesn't work exactly this way, but this is intuitively how it works. If you have these 2 bands, these 2 light bands, if you're within these 2 bands, you're in the normal type world, the normal risk environment, and if you're outside of this, then you're in a high risk state. Okay? And so when you plot it that way, this is a high risk state, and this is a low risk state as a 0, 1. That is, if you're within those bands, you're in a low risk 0 state, such as this environment here. And if you're in a 1, you're in a high risk state, such as essentially this environment through here. So again, this is, I don't want to drag you through all the details of this, but I wanted to give you an example of how some of this plays out in practice. Again, there's a paper in JPM I can send you if you're interested, or you can, I can send it to you if you're interested. That lays out, the technicalities of this. But
may I?
Please.
Thank you. Just a question. What you're basically measuring is past losses. And you say when past losses have been big, your expected risk, expected shortfall, so your risk is high nowadays.
Right.
But basically, this is just leading to pro-cyclical conclusions, and you will not enter into a buying signal at the bottom.
Right.
How about to deal with this critique?
Right.
Typical critique for this type of
Yeah, so well, there's sort of two. I think there's two critiques there actually, if I'm interpreting you correctly. And it's okay. So what you're suggesting is that first of all, it's really backward looking.
yeah.
Right. So let me back up a second and talk about this a little bit. The way we put this together is that we only to do our 21-day forecast. We're only using data that we had at the time of the forecast. So our database starts around 1995, and we withhold 3 years to kind of train the model. And then we begin our forecasting around the year 2000. So in the year 2000, when we first start this, the model only knows 95 to 2000. It doesn't know any of this ever happened. So it's backward looking in the sense, you're right, in the sense that it's backward looking given what it's seen. And that's a very valid point. But having said that, it's not backward looking over the entire history. And you can see that even though it hadn't seen this event before, it still knew that something was happening in the CVAR. And the reason it knew that is because the model observed correlations, covariances rising. So it recognized that, and it said, there's something abnormally happening here. We're out in this left 5%. It doesn't know that something bad is going to happen. It just knows something abnormal is happening, which triggers us to be risk off. So I think that hopefully that answers your question. And it's partly right, but I wanted to be clear about how we put this together. So it is ex ante. It is ex ante, but you have to train them all. So there's some of that. The second point. So let me just say that it's not exactly contemporaneous, right? I mean, it is a forecast. And so the second point about, well, when does it say, well, things have returned to normal? And one of the challenges with using this type of modeling framework is it is a risk type framework, and so it thinks in two states. It thinks in a normal state and a high risk state. And if it's in a high risk state, it's not easy to get it out of that state because the model needs something to move it, and it needs evidence. And so it does need that history to occur before the model will say, okay, things are kind of back to normal. We can now presume going forward that we're in a normal risk state. And so you're right that it takes longer than any of us would like to move back into sort of a normal or a risk-on state. Versus what this model is going to do because it is backward looking. But even having said all of that, even with all of that, we still absolutely crush a static model. Here's the static model. And I say static, we're rebalancing every month. So here's a risk return. I'm using drawdown here, not standard deviation. You can do this in standard deviation space or drawdown space, but we're using CVAR, and I've argued that standard deviation is not the right risk metric, so we're going to use drawdown. And so we're going to rebalance these portfolios every month at the same time. So there's no hindsight bias, there's no rebalancing bias, there's no unfair race. It's a horse race, but it's a fair horse race. And we're going to rebalance these portfolios at the same time every month. And we're going to, here's the benchmark. So this is the benchmark, the 5 asset classes that I showed you. And then here's our unconstrained model. And then here's a model where we only allow asset classes to range by 10%. And so even with all those caveats that you so accurately point out, this one model, and I'm not suggesting this is the model that you should use, but this one model has performed extremely well versus being static. So I think we can do better, and I think that there's a direction for us to move. I was going to say something else. I've lost my train of thought there. So here's how, and so this is not all due to avoiding, oh, that's the other point I wanted to make, is this point here. So this is not due to simply avoiding, I think the referee said, well, you just avoided the 2008, 2009 period, and so that's the reason for your results. And so we said, well, let's go back and look. And so that's simply not true. You can see that this is, there's outperformance here, of course, but also back here in 2000 and then in the 2005 period. So it's, it is largely about containing the downside, but that's what asset allocation really should be about. We know that if we can manage volatility, we have a much higher Sharpe ratio, we have higher portfolio returns, because we know geometric returns are a function of what? The arithmetic returns minus the volatility, right? Minus 1/2 the standard deviation. So managing that standard deviation is very, very valuable. Again, so the other thing I wanted to say was that, again, this is just one model. I propose that that we put into place as asset managers in practice what I would call a risk management dashboard. And so what that dashboard is akin to, it's akin to any other dashboard that you use to manage and control risk. If you're flying an airplane, you don't have one instrument that tells you what's going on. You have a host of instruments. Same sort of thing, of course, for a car. You have a host of instruments that tell you what's going on and give you fair warning. This is just one instrument. There needs to be others, and there should be others, in your regime. Your daily things that you look at. Okay. Okay, so this is a slightly different topic. Before I move on, other questions or comments about that? Okay.